You're not gonna show our video, are you?
I have done that, yeah. I'm gonna just put, you're gonna be with me for this. I could turn to you with this academic question.
That's fine. I just got that and stuff.
All right, sure.
No,
Is that better?
not really. Okay. No.
Okay, that's fine.
I don't care about hygiene spot on this one.
It's not marketing.
All right. I'm just going to keep letting people in.
Great.
Welcome to the Hedge Call, everyone. Matt, do you want to jump in?
Sure. It's great. So thanks for joining. We appreciate everybody being here today on the call. We have myself, Imran, and Brent. And as a reminder for what the goal of the call is this is meant to be a Q&A session where those that have subscribed to the Hedge can come and ask questions about both the material in the course and also anything in the glossary or anything having to do with terms that are shown throughout the course. The three areas that we're hoping to support and help provide education in are around options, education, and training directly through the Hedge. Secondly, Imran has his Macro Insights course. With your subscription, you get 1 month free to that. One thing we do suggest is that you consider enrolling in that maybe a few weeks after starting with the Hedge, so that way you give yourself a little bit of time to learn some terminology, get comfortable with the options level where you signed up, and then activate the Macro Insights portion. So with that opportunity with Imran and that subscription process later, if chosen, what you do is, Imran, you good?
No, a couple of people are saying there's no sound. A lot of people on the chat are saying there's no sound, which is strange. I can hear you. You can hear me. Can you guys not hear? Can you guys not hear either of us, or you just can't hear Matt?
Click join audio on the bottom left.
You guys have to click join audio in the bottom left.
I think individual users have to click join audio.
Yeah. Some people have got sound, right? It's just some people haven't got sound. Yeah, you have to activate your sound. Yeah.
Okay.
Yeah. We got some Zoom newbies. Maybe you activate your sound. Right. Okay.
Okay.
Sound good. All right, good. Yeah. So someone who didn't have sound now has sound. So that was on their side. Sorry, Matt. Carry on.
Okay. No, thanks for the heads up. Just to recap that first part very quickly. Thanks for coming. Thanks for enrolling in the Hedge. This is one of three areas in which we're providing education and or resources as our partnership through Options Insight. And on the Hedge, we're providing education directly. This is a Q&A session. So it's focused around the material in the Hedge. Our goal is to open it up first for questions more at the junior trader level, then senior trader, then portfolio manager, but we'll take questions as they come. Please put them in the chat line. The second area in which we provide support is through Macro Insight, which is Imran's subscription membership options course and trading course. That has calls weekly going forward. You get 1 free month by signing up for the Hedge. So you can activate that when you're ready. That's sitting in your course subscription. So within Learn Worlds. And then the third thing is Spot Gamma obviously has our subscription service, and if not a subscriber, you can get a 7-day free trial and go there. So for today, again, this is a Q&A session around the Hedge. Brent's here, I'm here, and Imran's here as well to answer questions you have. I think we would like to start, if possible, and comfortable with some of the questions people might have on the more junior trader section or more of the basic terminology or information, then move to senior trader, then portfolio manager. And again, if there's really more advanced questions, we'll just jump to that. So sound good, Imran?
Sound good to me. So, feel free to say hi as well. No one's turned their camera on except for us lot, but it'd be good to get to meet some people as well. But if you're shy, then just stick your questions on the chat. So what are we thinking today? Or should me and Brent just talk about the market? We'd love to hear more info on Spot Gamma's sub features using Hero Dark Pool info. Well, that one's not for me.
All right, Brent, you want to do a 30-second infomercial on Hero? We did not plug that question. Amy can't find audio. It was the bottom left for me.
Yeah, so while we're sorting the audio issue there, in terms of the Spot Gamma subscription service, we offer a daily analysis it's a written analysis that we send out every morning. And that describes how much volatility we expect to see in the market today. So how much do we think the market is going to move? And then where are the big support and resistance lines and those support and resistance lines are based on the options positioning in the S&P and in the NASDAQ. So for instance, today we were looking for a lot of volatility. We had an expected one-day move of 1.3%, and we're looking for resistance around 4,700 and support around 4,580. So based on those levels, traders will take that information as well as sort of our analysis of how the options position have changed or has changed sort of, from yesterday to today. And they will our readers will seek to structure trades or their investments sort of around those views in the market. Now the Hero system in particular is a new product rolling out in the next couple of weeks. I think we're looking for around February 1st to launch that. And what that product is going to do is it's going to read the real-time options trades from a delta perspective. So for those of you who are trying to figure out, hey, are people buying calls in Tesla or selling calls in the NASDAQ, this product or this tool will actually tell you explicitly if that's taking place, how much call buying or selling is taking place. And we express that through what's called delta, which as you guys have gone through the hedge, you should understand what we're getting at there. And then lastly, we do have some dark pool data. And we have a dark pool page that tells you what the 5-day average dark pool buying and selling flows on each individual stock, and we also break it down by sector so you can get an idea of the activity taking place in those dark pools and possibly find some tradable information in that tool. Lastly, we also have something called the Equity Hub, and that provides the options position on, I believe, around 3,500 different stocks. Essentially, if the stock has an options complex or if it trades options, then you'll find the options position for that stock in our Equity Hub tool.
And the question here from Ramin about the beta for Hero. Right now, we're finalizing the product for an initial launch. It'll be more of a soft launch, and it'll go first to Spot Gamma users in the February timeframe, probably at the beginning of the month. And that'll be likely at a reduced price for Spot Gamma users to start with, and then we'll launch that out in the March timeframe more publicly. Right now, the product is available. We launched it in May of last year in 2021 through Bookmap, but you need to have their futures platform to have that overlay. So we'll be launching it uniquely through the Spot Gamma site again in the next 3 to 5 weeks. There is a question for you, Imran.
Yeah, so how can you see the difference between short-term and long-term implied volume options? So that's just on whatever options platform you're using. The visualization of it might be different, whether it's Tasty Trades or whatever interactive brokers that you use, but that's just the term structure. That's what we call the term structure of volatility. Normally they plot the at-the-money term structure. So they plot the implied vol for at-the-money strikes across all the different maturities that are available, and that is the curve, what we call the term structure, or the at-the-money vol curve is often sometimes called. VIX Central that someone shared, that's not really the at-the-money term structure, right? That's the term structure of VIX futures, which is kind of like a derivative of the term structure of the S&P surface. But there's quite a lot of complication of how you get from one to the other. They're not the same thing, yeah. Did that answer? Hopefully that answers your question. Otherwise, you can just look at the options chain as well and see for different maturities what is the at the money vol, and then go to another maturity and look at the at the money implied vol. As long as you've got IV there, implied vol there, then you can see what the difference is between your different vols, different maturities.
And to that point, not to kind of plug a Spot Gamma feature again, but we're rolling out an implied volatility dashboard, which we're hoping to have for February 1st as well. So that's going to show you the implied volatility term structure, basically, for the indices as well as individual stocks.
Cool, that's good. I didn't know you were doing that. I'll look forward to seeing that myself.
I also hope it's ready for Feb 1. It will be ready in the next 4 to 6 weeks.
My job is to overpromise.
Obnoxiously basic question. My apologies. When you talk about vol points, this means a percentage point of implied, right? You said that when you're looking at one of those charts on the yeah. So when I use the word vol point, I don't mean percentage of the vol. I mean one vol difference. So if the implied vol is 20 and it changes to 21, it goes from 20% to 21%, then that's a one vol point move. Even though as a percentage, 1% as a percentage of 20% is actually 5%. But I generally don't tend to think of vol in percent of the vol level. That's not something that I've done over my career, and I find that useful. I like to think of it in vol points, i.e. 1% of vol is a vol point. Yeah. But don't worry about it being a basic question. That's the whole point of this call. Yeah. New member reading a lot of your blogs, having
I
difficulty
can
determining.
answer that one quickly. Yeah. The question about the spot gamma system and things, Ramin. So we have a glossary on the free resources page of spot gamma. So if you go to the glossary, that should have those terms in there. So what is a put wall? What is a call wall? What is our vol trigger? Which are proprietary or not? And how do those work? I know that Doug's articles are written at kind of a sophisticated trader or almost institutional level. Those are on purpose because we're trying to make sure we can bring people up to that knowledge base if they want it. But I realize there's a lot of terminology used very quickly that's sophisticated. So again, under the free resources tab within the glossary, if you type in the terms from the blog that are new to you, hopefully not only is there a definition, but there might even be an example from it.
Okay, good. We've got lots of questions coming through. Okay. Other than the VIX futures curve backwardation, is there any way to gauge how expensive Vega is? How about vol of vol? How would I read into VVIX? Sem mentions fixed strike vol, but I don't know where we retail guys can measure that. Okay, so there's a few ways you can do this. So it's a really, you don't worry too much about the VIX backwardation, right? Because yes, it tells you that vol is higher than it was, fine, and the VVIX is about the volatility of the VIX. So that only really matters for VIX options, right? If you're trading options on the VIX, that's when you care about VVIX, okay? Now, obviously, all these things kind of are correlated to each other, right? So when the VIX spikes, the VVIX often spikes. And so there will be some correlation there. But if you want to really look at something and get a handle on that specific thing, fixed strike volatility is just, you pick a maturity, you pick a strike, and you look at the implied vol of that, and you monitor how that vol moves around, okay? Now, Interactive Brokers, I know, has got something called the Volatility Lab. And in there, you can monitor what implied vol is doing, not for a fixed strike, but for the at the money strike, let's say. And you can go back 6 months or whatever, right? And you can pick what maturity, and you can see how that's moving around. So that gives you a basic gauge for where at the money implied vol is versus its own history. So that would be a go-to place for me. I don't know if there's a retail platform that gives me the plot of the implied vol for a fixed strike option where it doesn't actually change the strike to be the at the money wherever we go. I'm not entirely sure I've got a platform. Do you know of a platform that does that, Brent?
No, but I guess what my question is for you, Imran, is how valuable do you think that fixed strike implied volatility reading is for the average?
I think it's super valuable because when you trade an option, that's what you have exposure to, right? When you buy or sell an option, the strike doesn't change the next day just because the market's moved, right? The option you're exposed to is the one that you bought, which has got the same strike that it had yesterday. So you care more, arguably, about what fixed strike vol does than you care about what floating strike vol does. Floating strike vol gives you a gauge for where, if vols have got extreme, right? And they're at the top of their range and they might come back down and stuff like that. But in terms of the actual Vega exposure that you hold on an option, it's fixed strike. So I think it's very valuable, and you do want to know it, and you do want to know if it's high or low. You know, plotting it on a graph and looking at it as a time series, day on day, that's not necessary. But knowing if you're getting into that fixed strike vol at a low level or a high level is useful. Yeah. All right. Anyway, butterflies, condor strategies. Makes sense when when short implieds are high and you think vol will decrease? Well, ironically, I would say when short-term vol is high and you think it's going to go down, you actually would rather just sell outright straddles or strangles, because that's what gives you more exposure to the vol going down. What butterflies and condors allow you to do is cap your wings, cap your risk. But by capping your risk, you're actually buying options back in those wings. And those options also contain volatility. So you probably have less short Vega exposure than you would have if you just smashed out the straddles or strangles, right? But I would argue when vol is medium to low and you still want to earn carry, but you don't like the idea of being outright short vol because vol's not super high, that's when I would look to iron condors and flies, because I'm more comfortable earning carry in a contained manner when vols are low, because vols could easily spike from here. When vols are super high, I'm getting paid to be short vol, so I'll just go short vol with straddles or strangles, right? If I've got the risk appetite and I've got the margin available and all that stuff, right? But I would argue not condors, the conditions for condors and flies, if you've got the appetite to sell outright, are not when vol's super high, because you'll just be selling outright then. Yeah. Hopefully that answers your question there, Peter. Can I find a graph of the skew on Deribit? Deribit might have integrated some stuff from GVol. I believe they have, so you should be able to find it on Deribit. But I just use the GVol app anyway, and their basic tier is free. But Adam, I think you're one of my macro insight guys, so we can talk about that offline. Yeah, we can talk about it in Telegram or something. Yeah. In your segment on call spreads, the payoff charts show that when the price of underlying reaches the price of the short call, there are no more further gains to be made. Is it the case that there is no more payoff, or that there is relatively very little left to be made relative to what's already been made? Okay, so remember, the expiry payoff of a strategy is not the same as what the price of that strategy will look like over time. Well, the expiry payoff only tells you what it's going to look like on the expiry date at the time it's going to expire, if spot is at those different levels. The actual true path of that call spread, it will go up in value as we keep going up, but it will go up at a slow pace. It won't be explosive. It won't be very monetizable, because it will rely on the short leg of that call decaying away to zero for you to actually make the maximum amount of that call spread, unless we just smash through it so far above the top strike that both options are just miles out of the money now, and then it would have maxed out, and then there's no more money to make, right? But the path of that call spread is going to, as we trade up towards the top strike, it will go towards its maximum amount, but because there's time left on it, it will still be a fair amount away from there. You'll have to wait for the passage of time. You have to earn that money through the passage of time. Yeah. I asked this because of a conversation with a friend who told me that maximum payoff doesn't happen until both options have a delta of 1. Exactly. Both options have a delta of 1 when you are above the top strike at expiry, because we are long gamma as we're close to the long call, and then become short gamma. Exactly. So as you become short gamma on the short call, then your P&L is actually coming to you via time decay, right? Which is what I'm saying there. Okay. Am I up to date on all the questions? I think I am so far. Okay. Boom. Any more? Keep them coming. Keep them coming. It's a quick fire round. It called you. He's got a question for you guys.
Post Gamma team, that's us, I guess.
We call it a lot worse, Peter.
Yeah, so I don't know that I would call it overextended. I guess what our philosophy is with the put wall is that we believe that people have a tendency to want to close puts when they become at the money. And that is because the gamma there is high, so your payoff starts to kind of maximize as you kind of get into that level. And so the other thing is during crashes, when implied volatility is really spiking, you want to sell your puts when implied volatility is spiking. I mean, one could argue, right? So when you're trying to want to maximize your payoff there, we think that oftentimes that happens when the put kind of hits the at the money level. So like 2 days ago in the Qs, 380 was the put wall, and we saw a lot of puts getting closed when the Qs hit that 380 level. So if it moves through that strike, I don't know that I'd necessarily call it overextended. It sort of depends on who owns the bulk of those puts. And I'll give you an example that in March of 2020, there were many very, very large put positions that went deep in the money. And the put positions that were on were all tied to the March quarterly expiration. So there are big funds like the JP Morgan Collar Trade or Bridgewater or whomever, that when they buy put options, they buy the quarterly expirations and they hold those to expiration. They won't ever close them early. So in that case, if a lot of those puts are tied to one of these big quarterly options positions, those aren't ever going to get closed early. So that probably doesn't necessarily answer your question the correct way, but we say in general, the put wall is this area where we look for puts to get closed, but I wouldn't say it's overextended because the market goes below that put wall. I hope that sort of helps to answer your question, kind of in regards to that. So it's sort of a conditional metric.
But the two main things to his second part of his question about should it move down to support further price declines, there's a resetting that takes place, as Brent said, around quarterly rebalancings or around hedging pressure closer to options expiration. So what you can look for is every night we refresh our levels. So each morning, if it breaks the put wall the next day, you'll know from the spot gamma levels in the morning, the put wall reestablished just below where it was, or further below. So we look for support as it approaches that level. Yesterday, if you looked at our level in the morning, we put 48.50 as the low on the SPX for the S&P.
You mean 45.80, yeah?
I misspoke, thank you, 45.80 yesterday. If you look at a chart from yesterday, the market literally dropped, what was it, close to 1.7%, right to that line and bounced off of it. So that held incredibly tightly yesterday, right to our level that we put out in the morning. So put wall, I think, can serve as a really good level of support in the market to watch. And if it bounces off, some people then feel more confident initiating a long position. Some people might feel more confident selling puts below that level if it shows as a line of support. And when it breaks through, as Brent's saying, it does depend a little bit on the timing relative to expiration and the sizing of that gamma bar there for whether it acts as a magnet to pull it close in expiration and kind of hold it, or whether it breaks back.
If I could jump in. So I would say, right, that none of this is an exact science. Okay, the reality is that we are trying to identify a cohort of market participants who are going to have motivation to do certain things at certain levels. Okay, and by seeing where the put wall is and knowing that there's a large amount of short gamma that kind of reaches a peak around that level, as Brent said, that means the probability that implied vols are going to spike as we enter that level are very high because the whole street is short at that point. If implied vol does spike as we approach that level, what are the participants who are long protection likely to do? They're likely to monetize. That would involve them selling vol, buying delta, and that will create a bounce. So that's the idea. It's not foolproof. It doesn't necessarily always happen. But what we're trying to do through the positioning is identify stress points where we can predict with slightly more certainty than random that participants may act in certain ways. And those flows, as and when they come to the market, often trigger bounces and movements and stuff like that. And we saw a perfect example of that yesterday, basically, I would say. Yeah.
Yeah. Two other things to add to that. One, we have on our blog some statistics around how the walls shift and what that moves. One of the best signals for a rally is the put wall shifting to a higher strike. And that is an indication that people have closed out some of their puts. And so that put wall moving up is an indication that puts were closed, and then the next highest level or whatever puts rolls up. So check out those are again stats that are lined up. The second one is the hero indicator is one of the things that we built to fill this gap that Imran was talking about. So we have this idea that 380 should be this level, right, in the put wall for yesterday. Now we can see when the market gets to that line, the real-time indicator is showing us, look at people are selling puts because we can tell the long deltas pick up. We could tell that puts are being sold. And so that's giving us the confirmation. We know what happens at 380. We know what the position is at 380. And then the real-time flow is confirming to us, okay, look, we thought that puts were getting could get closed at this level. Now we can see that taking place, and we know there's a lot of puts there, so there's a lot of gas for the market to possibly rally back.
Yeah, makes sense. Okay, so hopefully that answered your question, Peter. How would you read into implied vol, premium, or discount? Are they reliable indicators for market turns? Yeah, see, I think they're a piece of the puzzle. For me, an implied premium or discount to realized, I'm assuming you're talking versus realized vol, is just giving you some potential indicator of positioning, right? So just like, spot gamma makes the assumptions on index, let's say, that on the upside, dealers are long, and on the downside, dealers are short. So, you'd like to see that to confirm that, you'd like to see on the upside, if dealers are all long, right, then there shouldn't be this massive implied vol premium, because dealers will be dumping vol that they don't want or isn't carrying. And so the spread between implied and realized will compress, and that will confirm that dealers are long. If on the downside, implied's up here and realized is down here, and the spread is quite juicy, that also confirms that positioning is likely short. Yeah. So that implied premium or discount is basically just giving you a little piece of the puzzle as to whether or not the street is likely long or short. That's how I read it. Whether it doesn't really help me pick a turn, but it's an ingredient. It may be one of many things that helps tell me what positioning looks like, which then may help me then get some guidance on what I think about the market movement going forward. Yeah. Anything to add on that? No. All right. On the upside, you're always right that it's overextended when it moves over the call wall. That's why I asked if it's similar on the put wall, but it seems not. I see. Yeah. Yeah, but on the call wall, it's different because we're assuming the street is very long, right? So we're also assuming that as we're breaching that call wall, dealers have got loads of delta to sell. And it is that delta selling that arrives that will push it back down towards that call wall. So that's why why they're using the overextended terminology, because we know the marginal dealer flows will be causing mean reversion back towards the call wall, because that's where all the gamma is, right? Is that fair to say, Brent? Okay. Anything else? These calls, are you planning any more of them? We do them every week.
I've answered in the text just below that.
Okay. Our pleasure. Okay, so there's no more questions then, yeah? All right, cool.
Right now. We had a couple more people join recently as you let them in. So
size 5-day data. Yeah. That's for you guys.
Before Ramin's question, which is a good one, we are going to also record these and keep these in the portal though, so you can go back and look at the Q&As. So these will be here for you as a Hedge subscriber. There's another question, I believe, Imran, from Ramin.
Yes, for you.
Oh.
It's about data on the levels.
Oh, within Spot Gamma. We haven't chosen to do that yet. We may do that in the future. I appreciate the question, but as of right now, we have not done that yet. That could be a Q1 or a Q2 upgrade. We've got lots of large hedge funds, institutional groups come in and ask us for data sets. So we're determining how and when we can provide those. But that's not how we're currently set up. Brent, is this us?
Yeah.
Yeah.
Russell and the diamonds, no. The options positions are not very consistent in those products, and that's why we don't talk about it as often. Meaning the open interest can skew a lot more. Some days it's much bigger, whereas if you look at the S&P, you can count on the distribution of options there. There's a consistent amount of open interest, et cetera. And the same thing is in the Qs, particularly now Qs have offered weekly options kind of in the last about 6 months, I guess it is. They offered the Monday, Wednesday options. So we haven't run that study on Qs. Our plan is to actually in the next couple months to run a similar study on Qs now that they have what I look at as a more consistent open interest framework, again, because they just fairly recently started offering the Monday, Wednesday, Friday expirations. But what's also tricky about the Qs is the NDX is also not a very consistent options complex.
Yeah, it's not as liquid as S&P. It's so much less liquid than the S&P. Like from my experience, whenever I was dealing with the US desk when I was in banking, I mean, it's just the volumes that go up in NASDAQ relative to S&P are nothing, right? It's just, anyway, the next question is, what's this baller? Just a bunch of ballers.
Troy had some kind words that were hilarious, and then so did Ramin afterwards. Thank you both.
Your levels have been great in setting up trades. Thank you. Thanks to Imran. The reason there is no questions is because Imran did such a great job. Very kind, Ramin. Thank you. Thanks for those words.
Just above those, Darius did have one question.
About risk-free rate. Yeah. So the interest rate feeds into the forward, right? So if you're trading 3-month options, because they're so short dated, the impact of a rate move is very minor to what it does to the forward and therefore what it does to calls and puts, right? Because think about it. If you're talking about at the money calls and puts, then okay, they're a 50 delta option. If the forward moves by a few basis points, then your option price is going to move by a few basis points times by a 50 delta, which is half of that, right? So if you're talking about out of the money options, relatively short dated, then the marginal impact of a rate move on option prices is minor. It's only when you're going into the realm of 2, 5-year, 10-year type options where they have a chunk of forward risk on them, right? The 5-year forward can actually move quite a bit when rates move, yeah? And if you have an option with a decent amount of delta on it, then your exposure to that forward is your delta exposure, right? The delta exposure you have on a vanilla option isn't actually pure spot exposure. It's exposure to the forward. It's just that for short dated options, those two things are almost the same. So we kind of don't worry too much about the rate side of things, right? But it's all about how long dated you go. And I'm assuming from a retail perspective, you usually keep things quite short dated. So it's not that big a deal, I would say. Hopefully that answers your question, Darius. All right, I think we are pretty much done, aren't we?
If everybody's in from the weight room, because we indicated this week would be a little bit more tilted towards more sophisticated questions later in the session. If everybody's in, and Adam just has a question.
I don't day trade, but are these levels, could they be used for entry levels for intraday trading as well as seeing the movement in levels for direction?
I think on that might be us on our side. So I think, Adam, to that point, I mean, we have very large wealth advisors that trade once a month that subscribe to Spot Gamma. And for instance, say they want to buy Intel or some sort of a tech stock, they will look at our levels for entry and exit points around a fundamental thesis. So our goal at Spot Gamma is to provide insights into how the options market is driving the short-term moves in the stock market. I don't think that I know Spot Gamma is not useful for somebody that says, I want to know what's happening in 2 or 3 or 4 months. That's not what we do, as I'm sure you know. But what we are helpful for, I think, is 2 different types of investors from that perspective. The one that's trying to make their short-term trades even on a daily basis or intraday basis using those levels. And the second one is somebody that does the fundamental work. I was a biotech investor myself for a decade, and I used options, but not the way that Imran and Brent have, that quantitative analytical experience of really being at top banks using them. I used to use my fundamental understanding of science and then use the options to put in my positions. If I had had the Spot Gamma levels and also some of the thought processes from Imran's calls on macro insights, I think I would have had a much better series of entry and exit points when putting on 3, 6, 12-month positions. So again, I think the levels are useful on a short-term basis, and they're useful to really fit any kind of a trader or investor. Also within the Spot Gamma Equity Hub, we do have new scanners that we put in and ways to generate watch lists, which allow traders or investors to make decisions or search for different features. So you can search now for Gamma expiring on Friday. You can search for names that might squeeze. You can search for different types of profiles. You have 9 or 10 different scanner functions now. So people that are looking for new trade ideas, we also try to provide insights. But it's a great question / comment that we really try to help both idea generation, whether through, Imran does that in his macro insights call. We do that through Spot Gamma education. We focus on that through the academy, and then entry points, whether short term or longer term. We do that through utilizing our levels. Hopefully that's helpful.
Ramin's asking about the Equity Hub 1.0 and 2.0.
So great, thanks, Adam and Ramin. So we might drop that nomenclature. Actually, it's kind of I view it as one thing. What we did was we were doing the S&P only in the major indices in the middle of 2020, and in late 2020 we launched Equity Hub 1.0. Brent's very technically proficient, obviously, and really likes having the put and call lines be separate. He thinks that evaluating those independently gives more sophisticated traders more insights. Some people like to look at the Equity Hub 2.0 charts. Those are the ones that are in the same portal area, but they have more of a color gradation, which allows you to see just by looking at it optically, where is pressure building or declining around different price points. And so I think between those two, people use different ones for different reasons. So I think we're probably going to, in some point in February, if not in the next few weeks, drop that 1.0 or 2.0 nomenclature, combine it, and just say, here's Equity Hub. Here's a look at the put and call gamma line split out. Here's a look at the whole picture, including our spot gamma momentum indicator. And that way it just gives you every look at what we're seeing in the market. And then I guess, Peter, real quick on that one. The future info, I don't know if you might have joined the call a little late, is we're looking to launch that around Feb 1. So you'll be hearing a lot more in the coming weeks. The team was full out. We have one team, right? So the team was full out working with Imran and getting the academy up and running in December, which we're excited about. And now it's the same people and tech groups that are going to have to work on getting Hero finalized and over the finish line. So our goal is to have that ready for Spot Gamma subscribers by early February, and then do a broader launch by early March. Ramin, thank you. Yeah, we're going to have, that's good feedback. Thank you. As we work with the dev team, we'll see what can be done with the interface to make it most convenient as you're looking between the individual lines. Hero actually is going to have a feature where it shows the single line of the total pressure of momentum during the day, and then there's a button to click that switches it just to put and call wall. So we'll see what we can do on the core site. Thank you, Peter. Yep, we'll get it ready as soon as we can.
Yeah, people are just saying bye now, I think.
Anything else on Q&A questions around, I think that was Peter thanking us for the last question. There you go, Imran. One more question on real stuff for the.
We still categorized yesterday as a short cover rally fueled by Delta, puts closed or rolled, and Vanna implied vol crash. So for the rally to be more stable, you would prefer to see the SPY call open interest. Okay, that's for Brent. So what would you want to see from yesterday to make you more confident that's not just a short cover rally, but a sustainable rally?
Yeah, I want to see a reduction in the put open interest. So I want to see that puts were actually closed or they were actually rolled farther down, sort of out of the money. But also a material uptick in call positions, right? Because I think new call positions give the opportunity for the market to extend rallies. And that's a function of the fact that usually people buy calls that are, slightly out of the money, right? And so as the market rallies, those call positions pick up gamma and they can keep the train sort of rolling forward. But what we saw yesterday was essentially that call positions didn't change, put positions didn't really change, but implied volatility got crushed. So all those puts are still sitting there and implied volatility got sold. But if we get any weakness, implied volatility is going to ratchet back up and the dealers are just going to re-short, right? So and those put positions are still there. So essentially we're sort of just in this vacuum where we can just continue to move up and down. And there wasn't, in my view, material change in call positions or something that might extend kind of that rally, right? That's really kind of what the difference is. Now, if you think about the concept of, a short cover rally, you get artificial buying essentially, right? Because people have to cover their shorts. They tend to have to be more aggressive. And if they're the only bidder, if they're the only buyer, then once they're done buying, there's no one left to support that market. And that's kind of a similar thing here, right? if you
That's
don't
what
have,
we've seen today, right? We faded 50 points. Right?
yeah, right, because there's nothing, think about it too. New call positions mean that there are more deltas to buy from market makers, right? And as the market keeps going up, they buy more and more and more calls, or excuse me, they have to buy more and more stock to keep themselves hedged as the market goes up. So that in my view is what really can help extend that rally. Again, as opposed to the fact that basically we sold off implied vol yesterday, and that was basically about it. So if vol goes back up, the dealers are going to short again.
Great. And Peter, again, thanks for the very kind comments. This was what Imran and Brent and I saw was, we weren't going to teach people what a call and a put were for the first time, right? But there really, I think, was a fundamental gap in the education landscape to really say, here is how you apply these, here is how you price options in a tangible way. So what we did was we launched the Academy, and within the Academy, this is the Hedge series. And what we're hoping to do, and Imran and Brett and I are brainstorming on this now, is the same way that, and Imran will say it live, he'll say it in his macro insights chats, is you've got to go do it and try it. And sometimes you got to burn your hand a little bit to know the stove's hot, right? You got to actually trade it and sometimes make a little money or lose a little money to get really comfortable. We're also considering rolling out some kind of a boot camp, whether it's quarterly or something where people can do some actual case studies. Imran's trained traders and investors at professional banks to sit down and say, hey, here's the example. It's 9 in the morning, implied vol is here, stock has been here. What profiles, condors, butterflies, what looks most optimal, and to run people through that. So we'll continue to work on education as a group here, Imran, Brett, and I, and also throughout each of our sites. But thanks for the kind words. It is something that is important to us from a mission perspective.
For sure. I mean, Rick literally just joined. So if he's got something to ask, I suggest you ask it now, Rick, sorry. Otherwise we're gonna end the call.
And for Rick and everybody else, again, if I didn't say clearly earlier, we will record these and put these under the call replay section within your portal for the hedge. So you can rewatch this or check out certain sections. And this is helpful for us too, guys. So thanks for joining. What we'll try to do as well is take this content and put it into the glossary or into more of a Q&A type of a transcript that's searchable after we get a month or two into doing these and build up more of a repository. So again, these are helpful to us to help educate more of your peers and our peers. So thank you. Okay.
Good to hear. Good to hear. Okay, call it a day.
Yep. All right.
See you next week. Bye.
All right. Good luck to everyone. Thanks.